749,000 barrels per day. That's how much Venezuelan oil just got cut off from global markets. Not proposed, not threatened, actually blocked. Trump ordered a total naval blockade Tuesday night. The U.S. military seized vessels. And this isn't some diplomatic game. This is real supply coming offline. Here's what Wall Street isn't telling you. They're saying oil prices won't move. They're saying spare capacity will fill the gap. They're saying Venezuela doesn't matter anymore. But crude jumped 2.5% overnight. Inflation just got a new fuel source. And your cost of living? About to get interesting. This isn't just about gas prices. It's about your mortgage rate, your grocery bill. Whether the Fed can actually cut rates next year like everyone's betting on. I'm going to show you the 4 data points that determine whether this becomes a $5 price spike or an $8 inflation crisis that rewrites your 2026 financial plan. Here's where it gets messy. The API reported crude inventories fell 4.8 million barrels last week. That's the sharpest draw since June. The market expected 1.7 million. We got nearly 3 times then. The EIA comes out Wednesday. Their number? Only 1.3 million barrels for the same week. 3 million barrel difference. Both can't be right. Morgan Stanley says the blockade won't move prices. The market is well supplied, they say, pointing to millions of barrels sitting on tankers off China waiting to offload. But David Goldwyn, a former State Department energy diplomat, says $5 to $8 per barrel impact if OPEC doesn't replace the supply. That's not a rounding error. That's inflation. China takes 68% of Venezuelan crude, over 600,000 barrels per day in December. Now it's unclear if those shipments continue. The White House says they're cracking down on a black market. Kevin Hassett, an economic advisor, told CBS he doesn't expect price increases. But he said that Sunday, before the full blockade was announced. Meanwhile, crude inventories are 4% below the 5-year average. Not critically low, but not comfortable either. Gasoline stocks jumped 4.8 million barrels. Product builds should mean lower prices at the pump. Except refinery utilization hit 94.8% last week. They're running hot. And here's the contradiction nobody's addressing. If the U.S. is blocking Venezuelan oil to punish Maduro, why did we just import 17% of their output this year? That's down from 34% last year, but it's not zero. Chevron still has a license. They're still loading tankers. So some Venezuelan crude keeps flowing north while the Navy blocks everything else going to China. Make sense? Me neither. Add this to the mix. Russia might face new shadow fleet sanctions if Putin rejects the Ukraine peace deal. That's another million barrels per day, potentially offline. Oil traders are looking at 2 simultaneous supply risks, Venezuela and Russia, both within 60 days. But Brent closed the week below $60 and WTI around 56. That's the lowest level since 2021, while supply threats are mounting. Buyers are frozen. Sellers are confused. Analysts are giving you 5 different narratives depending on which bank they work for. So here is the real question. What does the actual data say when you stop listening to the spin? Let me show you. Let's go through this piece by piece. U.S. crude oil inventories were 424.4 million barrels as of December 12th. That's 4% below the 5-year average. Not a crisis, but directionally wrong if you're expecting stable prices. Now here's what matters. 3 straight weeks of draws. 1.8 million, then 4.8 million from the API, then 1.3 million from the EIA. The discrepancy is getting bigger. API surveys 90% of the industry voluntarily. EIA is mandatory federal reporting. They usually track within 1%. This week, they're 3 million barrels apart. Why? Someone's not reporting accurately, or storage is shifting to locations neither survey captures fully. Cushing, Oklahoma, the delivery point for WTI futures. We don't have real-time data. But if Cushing is tightening while coastal storage shows builds, that creates a disconnect between paper prices and physical delivery. Translation: futures might not reflect actual supply stress until it's too late. Visualize this. 424 million barrels sounds like a lot. Divide by daily consumption, and that's about 21 days of supply if imports stopped completely. They won't, but the buffer is thinner than headlines suggest. Compare it to 2019 pre-pandemic. We averaged 460 million barrels, 36 million more than today. The 5-year average includes pandemic lows. So being 4% below that average means we're actually 7% below pre-crisis normal. Regional comparison. Europe's commercial stocks are also below average. China is building strategic reserves, but they're opaque about volumes. If China needs to pull from strategic storage, that demand won't show up in trade data for months. Contrarian twist. Everyone's watching inventory levels, but nobody's watching inventory velocity. How fast are barrels moving through the system? Refinery utilization at 94.8% means crude is moving fast. That high utilization with falling inventories is classic late-cycle behavior before prices spike. 749,000 barrels per day. That's Venezuela's 2025 export rate, according to Crude. Not the million barrels headlines claimed. Not even close to their peak of 3 million in the 90s. But here's what matters. 68% goes to China. That's 510,000 barrels per day. China's crude imports average 11 million barrels daily. Venezuelan crude is 4.6% of that total. Sounds small until you realize China operates on razor-thin margins. They've been building strategic reserves. Any disruption means pulling from those reserves or bidding up global prices. The U.S. imported 17% of Venezuelan output this year, about 127,000 barrels per day through Chevron's license. That continues. The blockade targets sanctioned vessels only. So what's actually being blocked? The 510,000 barrels heading to China, plus roughly 120,000 to Cuba, and another 60,000 to Spain and Italy, 690,000 barrels per day. Call it 700,000 if you round for vessel delays. Why it matters. OPEC has spare capacity of about 5 million barrels per day, mostly Saudi Arabia. Filling a 700,000 barrel gap? Easy, but Saudi is already cutting production to support prices. If they replace Venezuelan barrels to China, they're undermining their own price support strategy. During the Libya civil war in 2011, production fell by 1.2 million barrels per day, and oil spiked 40% in 6 months. Venezuela's disruption is smaller, but it's layered on top of existing Russian sanctions and OPEC cuts. It's not the size of the cut, it's the timing. The market thinks spare capacity solves everything, but spare capacity is in the wrong place geographically. Venezuelan crude is heavy sour. Saudi replacement crude is lighter. Chinese refineries configured for heavy crude can't just swap sources without yield losses. They'll pay a premium for similar grades or run less efficiently. Either way, that's price pressure nobody's modeling. Gasoline inventories jumped 4.8 million barrels last week. Product surplus usually means lower prices coming. Except refineries ran 94.8% utilization, near maximum output. If demand was strong, product wouldn't be building with refineries running full tilt. But if demand is weak, why are refineries producing so much? 2 explanations. 1. They're building inventory ahead of price increases. Refiners know something. 2. Distillate demand is weak diesel, heating oil, industrial demand. Refineries can't just make gasoline. The crude slate determines product mix. Distillate stocks increased 1.7 million barrels. but they're still 6% below the 5-year average. Visualize this. Gasoline is 7% above minimum operating inventory. Distillates are 6% below. That's a squeeze forming in the middle distillate market. Trucking, agriculture, manufacturing all diesel dependent. If heating oil demand spikes with cold weather, distillate prices could jump even if crude stays flat. Your grocery bill? Diesel drives trucking costs. Those pass through in 3 to 6 weeks. Why it matters mechanically. Crack spreads are refinery margins. The gasoline crack spread is thin. The distillate crack spread is wide. Refiners make money on diesel right now, not gasoline, so they're incentivized to maximize distillate output while gasoline keeps building. That imbalance corrects one of two ways: refinery cuts, which reduces crude demand, or gasoline exports increase, which requires international demand. Neither is bullish for WTI crude prices short term. Global comparison. Europe's gasoline stocks are elevated, and Asia is building inventories. This is a global product glut. But crude supply is tightening while products are oversupplied. That spread compresses, and when it does, refineries get squeezed. Product builds are being used as evidence that oil demand is weak. But product builds while refineries run flat out is not weak demand. It's a timing mismatch. Demand shows up in 3 to 6 months. Supply is responding now. The market is early, not wrong. Every $10 move in crude oil changes CPI by 0.3%. That's the Fed's own estimate. Crude at $56 versus $70 is a 1.4% difference, a 0.42% inflation impact. The Fed has been cutting rates. They want to get to 3.5% neutral by mid-2026. Inflation needs to cooperate. Oil at $60 is helpful. Oil at $75 is manageable. Oil at $85 and rate cuts pause. Here's what Wall Street misses. The Fed doesn't react to oil prices directly. They react to inflation expectations. If markets price in sustained higher oil prices, inflation expectations rise and the Fed stays restrictive longer. Current inflation expectation surveys show 2.5% for 2026, based on oil below $65. The Venezuela blockade plus potential Russia sanctions? You're looking at baseline crude 70 to 75, maybe 80, if China pulls strategic reserves. Why this matters? Mortgage rates track the 10-year Treasury plus a spread. The 10-year tracks Fed policy expectations. If the Fed can't cut rates as much as expected, the 10-year yields stay higher, mortgage rates stay higher, and housing affordability stays compressed. You're not buying a house because mortgage rates are 7%. Everyone's waiting for 6% or lower. That requires Fed cuts, and Fed cuts require low inflation and low oil. A $5 oil spike hits U.S. consumers harder than Europeans. The Fed knows this. The market thinks the Fed is data dependent. They are, but they're dependent on forward-looking data, not backward. Oil futures prices inform Fed models. The current futures curve shows oil below 65 through 2026. If that curve shifts to 75, Fed models shift, rate cut expectations shift, and your financial plan needs to shift too. 34 sanctioned tankers are currently at sea, carrying Venezuelan crude. 12 are full and 22 are empty or partially loaded, according to clear tracking data. The U.S. can seize these vessels. They seized one last week, the Skipper, with 1.8 million barrels on board. If they seize 12 more, that's 18 to 20 million barrels removed from the market instantly. About a day's worth of global demand held hostage. But here's the complexity. These aren't U.S.-flagged vessels. They're Iranian, Chinese, Russian-owned through shell companies. Seizing them is legally aggressive and internationally contentious. China is calling it piracy. Two scenarios unfold. 1. The U.S. seizes a few more vessels as examples. The shadow fleet reroutes to avoid U.S. patrols, and the supply disruption is temporary. Oil spikes 10% for 6 weeks, then normalizes. 2. China retaliates, stops buying U.S. LNG or agricultural products. An escalation beyond oil turns into a trade war wrapped in an energy crisis. Timing matters. We're heading into winter in the northern hemisphere, and heating oil demand peaks. January through March. China's diesel consumption peaks during manufacturing buildups before the Chinese New Year in late January. Disrupting supply now means maximum impact hits in 45 to 60 days, right when global stockpiles typically draw seasonally. Leading indicator. Watch ship tracking data. If sanctioned tankers start idling offshore instead of moving, that's supply being withheld from market and bullish for prices. If they keep moving under different flags, supply finds a way and you're neutral to bearish. Contrarian reality. The shadow fleet exists because sanctions don't work perfectly. They create friction and raise costs, but they don't eliminate supply. Venezuelan oil will reach China, just at a higher cost with higher insurance and shipping fees. That cost gets embedded in the price floor. The market isn't pricing that friction yet, but it will. All right, here's what actually happens and why almost everyone misses it. This isn't about Venezuela. It's about what Venezuela triggers. Oil markets are tight, not emergency tight, but structurally tight. OPEC has been cutting for 2 years, U.S. shale growth has slowed, and investment in new production is way down after 2022 losses. You've got a system running near capacity with no buffer for disruption. Then you layer in Venezuela, a small disruption that connects to 4 other pressure points. Pressure point 1. Russia sanctions. The market assumes Russian oil finds buyers. If the U.S. adds shadow fleet sanctions, that discount widens, creating more friction and higher prices for everyone else. Pressure point 2. OPEC spare capacity exists, but it's not free. Saudi Arabia doesn't want to pump more at $60. They want $80. Replacing Venezuelan barrels means undermining their own price support. They'll do it, but slowly and reluctantly, letting prices rise first. Pressure point 3. China's strategic reserves. They've been building since mid-2024 because they see the same tight market. If Venezuelan supply is disrupted, they start pulling from strategic storage, depleting the buffer for future disruptions and then bidding aggressively for spot cargoes. Prices spike. Pressure point 4. U.S. fiscal deficits and inflation expectations. The Fed needs inflation under control to justify rate cuts. Higher oil prices break that narrative. Markets are priced for 2026 rate cuts, 3 to 4 cuts worth 75 to 100 basis points total, and that requires PCE inflation at 2% or below. Oil at $60 gets you there. Oil at $75 does not. Timing destroys you. People think direction matters up or down, bull or bear. Wrong. Timing is everything. If oil spikes in February, that hits spring driving season expectations. Gasoline demand rises and prices stay elevated into summer. Inflation prints hot through June and the Fed delays cuts until September. But if oil spikes in April after winter heating oil demand fades, the spike is shorter and prices normalize by July, allowing Fed cuts to proceed. 2 months difference, same fundamental disruption, totally different economic outcome. The structural incentive Wall Street ignores. Investment banks need to maintain relationships with OPEC countries, Saudi Arabia, UAE, Kuwait. These are massive clients. When Goldman says oil is well supplied, they're not lying. But they're speaking from the perspective of someone who benefits from stable markets and strong OPEC relationships. Contrarians like us don't have those conflicts. We can say what the data actually shows. The market is tight, spare capacity is limited, and disruptions compound. Let me walk you through 3 paths: probabilities, Triggers, winners, losers. Base case 55% probability. Manage disruption. What triggers it? The U.S. blockade stays in place but is selectively enforced. A few more vessels are seized and most of the shadow fleet reroutes. Venezuelan crude to China drops from 510,000 to 350,000 barrels per day. A 30% reduction, but not a total cutoff. OPEC slowly adds 200,000 barrels over 6 weeks. Prices spike to $75 and hold for 3 months, then drift back to $65 by summer. Inflation ticks up 0.2%, enough to delay one Fed rate cut from September to November. Who wins? Energy stocks with a brief rally and midstream companies with long-term contracts. Who gets hurt? Consumers who see gasoline rise 30 to 40 cents per gallon and rate cut-dependent sectors like growth stocks. What breaks this case? China's strategic reserve is larger than estimated, and they release 50 million barrels over 3 months. Or OPEC blinks and Saudi adds 500,000 barrels immediately to keep China happy, preventing a spike. Bull case 25% probability. The collapse accelerates. What triggers it? Multiple stress points converge. Russia sanctions bite. Shadow fleet seizures escalate. China refuses to release strategic reserves. And Iran retaliates, threatening the Strait of Hormuz. Fear premium is added. Crude hits $90 and stays there for 6 months. Inflation jumps 0.5%. The Fed pauses cuts and maybe hikes once if inflation expectations unhinge. Recession odds spike and the stock market corrects 15%. Who wins? Oil producers, frackers, commodities, gold, and silver. Who gets hurt? Consumers, discretionary spending, retail, restaurants, travel, and fixed-income investors if the Fed hikes. What breaks it? Demand destruction from a recession, China's economy stalling, or Europe weakening, which could push prices back down to 60 by year-end. Bear case 20% probability, non-event. What triggers it? The blockade is theater, enforcement is weak, the shadow fleet adjusts, and Venezuelan oil keeps flowing through new channels. China negotiates quietly with the U.S. Shipments continue under different flags or through third countries. OPEC doesn't cut further, and demand stays soft. Crude drifts to $50 by March. Inflation falls faster than expected. And the Fed cuts 4 times in 2026 for a total of about 300 basis points. Who wins? Consumers, growth stocks, tech, and homebuyers if mortgage rates fall to 5.5% or lower. Who gets hurt? The energy sector with another brutal year and potential bankruptcies among small producers. What breaks it? It requires everything to go right. No geopolitical shocks, no Fed policy errors. Demand staying weak and supply ample. That's a narrow path. The market operates in probabilities, not certainties. The base case is most likely, but with a 25% chance of the bull case and 20% chance of the bear case. There's a 45% probability you're wrong if you only prepare for the base case. Smart money doesn't bet on one scenario. They position for all 3 with different allocations. That's what we build next. So what do you actually do? Not vague advice-specific actions you can take this week. Watch the WTI-Brent spread, the price difference between U.S. crude and international crude. Right now it's about $3 with Brent at 60 and WTI at 57. If the spread widens to $5 or more, that tells you global markets are tightening faster than U.S. markets. That's your advance warning system. Check it every Wednesday after the EIA report drops at 10:30 Eastern on sites like investing.com. What number changes your behavior? Spread above $5 for 2 consecutive weeks. That's your signal that prices are heading higher and you should act. Most people think energy stocks are binary. Buy them or don't. Wrong approach. Layer your exposure. Start with 5% of your portfolio in energy, focusing on midstream companies and pipeline operators, not drillers. Why midstream? They make money from throughput, not oil prices, and offer stable dividends with less volatility. If crude crosses 70, add another 3% for a total of 8%. Then add upstream producers with low break-even costs. If crude crosses 80, max out at 10% total and add refiners who benefit from wide crack spreads. If crude stays below 60, trim back to 3% and keep the midstream. Everyone says buy gold when inflation threatens. It's boring and expensive with no yield. A better approach is Treasury inflation-protected securities. Tips: I-bonds, if you haven't maxed them, $10,000 per person per year, are paying 5.2% right now, risk-free and inflation-adjusted. Or tips ETFs like SCHP and VTIP, which are liquid and trade like stocks. Position size: 10 to 15% of your fixed income allocation, not your whole portfolio. You can't trade crude oil futures, too volatile and capital intensive. But you can lock in gasoline costs through credit card rewards. Get a card with 5% cash back on gas. There are several options like Costco Card or Amex Blue Cash. If you spend $300 per month on gas, 5% back is $15 monthly or $180 annually. If gas prices spike 40 cents per gallon, the cashback offsets 10 to 15% of that increase. It's a micro hedge that costs nothing to set up. People make mistakes because they confuse time horizons. What matters in 6 months is whether the blockade stays enforced, whether OPEC replaces supply, and whether the Fed delays cuts. Your action. If you were planning a major purchase car, home renovation, anything with financing, lock your rate now. Don't wait for lower rates that might not come. What matters in 24 months is global recession risk, China's economic trajectory, and whether U.S. shale production accelerates again. Long-term, oil prices probably moderate as new supply comes online and demand slows. So don't make permanent portfolio changes based on temporary disruptions. Energy allocation is tactical, not strategic. You're trading the cycle, not marrying the sector. The patient strategy. Most people panic into positions after prices move or ignore the setup and miss the move entirely. Better approach. Small positions now with defined add points based on data, not emotion or headlines. That's how you win, not by being the smartest person in the room, but by being the most prepared. Next week, I'll explain why the Fed is trapped and what they'll never admit publicly. Here's the preview. The Fed is operating with a broken model, using inflation data from 2023 to make 2026 policy decisions. But the economy has changed. Labor markets are different. Housing is different, and the relationship between rates and inflation is totally rewired. I'll show you the 3 indicators the Fed watches that are in any news report, and how you can use those same indicators to stay 6 months ahead of their policy moves. That matters because every Fed decision affects your mortgage rate, your savings rate, and your portfolio returns. Being early isn't the same as being wrong. It's being positioned before the crowd reacts. If today's breakdown helped you see oil markets differently, hit subscribe. This is what we do every week. Cut through the spin, focus on data, and build actionable plans. Drop a comment and tell me, are you positioning for higher oil prices, or do you think this is noise? If there's a macro topic you want me to break down, suggest it. I read every comment. Some of the best episodes come from your questions. See you next week.